Hi, today's topic is two worlds. One will protect you, the other will harm you. There are two very different commercial worlds or approaches to valuing business today. There is the valuation world versus the accounting world. One gets its information from the markets, the other manufactures and manipulates its information from financial statements. If any report uses terminology such as future maintainable earnings, discounted cash flow, and apparently they can predict the future, add-backs, EBITs, EBITDAs, multiples high and low, or cap rates, throw it in the bin. Or, if you have suffered loss due to such a report, consider litigation, even class actions. According to a recent High Court decision, there is now no longer any legal protection for such methods. Anytime you hear or see these sayings, run for your life. Accounting, financial and taxation concepts based on cap rates or discounted cash flow will always distort and mislead, and they have no bearing on market activity whatsoever. Refer to Spencer's case 1907. This is a way for solicitors to know clearly what is a suspect report by its contents. Some even use sales from 50k away from the subject business and use sales from 20 years ago to bolster their reports. They even ignore the previous sale of the subject business, which has only been 5 years ago. Where is the logic? This is a new area of litigation for solicitors worldwide. Those who prepare business valuations should be trained in the valuation of tangible assets, such as all property types and rentals, vehicles, plant, equipment and chattels, and should be trained in the valuation of intangible assets, namely goodwill, and the first thing you should ascertain is their qualifications and experience to undertake such tasks. A lot of litigation turns on the reasonable person test. What would a reasonable person do? We'll try and find that in what they do. Every person in the business community and every support organisation should understand what goodwill is and how it is valued reliably. Every university, every training facility, every business school, every legal body and every forensic researcher should now teach and train professionals in how to value and measure the asset known as goodwill, together with all other intangibles that feature in share markets, tech stocks, patents, branding, etc. Now there is a way, and it's detailed in my book, but it must also satisfy the law, which we are going to discuss. We will now review the methods they use and show you why their reports are suspect and misleading and are outside the law. It is time we got behind the legal profession and provided accurate information based on current market conditions that they can consider reliably. Now, refer to the example on your screen. What is the most reliable and provable number on this reconstructed trading statement? Careful, there is only one. Can you figure it out? If you can guess the answer, you are well on your way to understanding intangible asset values and how to prove them. The answer is sales. There must be a source. According to Mulligans Case 1901, the judge said goodwill must come from a source. This number represents the source of goodwill value. And he further described it as the attractive force that brings in custom. The High Court of Australia reaffirmed Mulligans' case in December 2018 and others, and has now rejected the accounting concept of goodwill as being unreliable and referred to discounted cash flows and balance sheet methods, residuals, in valuing goodwill. I applaud the High Court justices for their incredible insight, knowledge, and perception of being able to see through accounting concepts as being unreliable. It has always been the case that accounting methods are opposed to market values. Sales is the only figure that is provable and is directly related to markets or customers. And it means that the business now has proof of its attractive force that satisfies Mulligans Case. It is dynamic proof or of actual transactions on which to base any valuation. If we can now accept that sales are the source of goodwill value, the mystery is solved. We can now identify it, measure it, and measure it reliably. And by the way, there is nothing else. The accounting world uses the lower suspect, unreliable and unprovable numbers, and their reports are flawed. They deny the existence of truth, plant and equipment. Their reports are not complete. Why would anyone use lower suspect numbers? You should never use net profits, add-backs, future maintainable earnings, EBITs or EBITDAs. Why? Because they are a product of management, not markets, and will misrepresent and mislead purchasers into believing that they can get that number. It is a written misrepresentation at law that is actionable. Net profits are not a predictor of value, they are a supporter of value. You will never receive them, so why in the world would you use them to predict values? That is the domain of fools. Today we are going to show you various examples of how most ignore markets and adjust numbers by sitting at a desk. This is what they do. Let's consider the first number they use and where they get it. They use the lower suspect numbers, namely net profit. Then they add back any vendor's discretionary income and basically any number someone deems appropriate. So this number is manufactured and manipulated without any support from market activity whatsoever and can never be proven. They use the worst numbers of a business, and these numbers are highly volatile and can have large fluctuations and again can never be proven. The High Court was right in rejecting these methods due to unreliability of measurement. But get this, someone who thinks they know about business comes along and says, to hell with judges and the owner of the business or management or their accountant. I will decide where the value is, and sets about altering financial statements starting with net profit, using add-backs, and produces an EBIT or EBITDA, or even worse yet, decides what the future maintainable earnings will be. They call this returns, by the way, and they declare to the world, you will get this amount of money. You will get it in perpetuity. What utter rubbish. You will never receive the numbers they predict. You will only ever buy the turnover, pay for that and nothing else. And it does not matter what they call it. It will never satisfy the law, either in reliability or accurate measurement. It is not based on any market numbers whatsoever and fails Spencer's case. Then we come to the second number that they use in their equation. So where did they get this number from? They call this number a multiple and various other names, low, high, industry average, or worse yet, they call it a cap rate. Most don't know where it comes from. They simply pass it on from hearsay or guesswork or past rehashing of same methods. Always attack this methodology because it is unreliable and it is not based on any market numbers whatsoever, even though they claim so. It is this number that allows them to declare a result or value, but it is always flawed. If they cap this number, they are declaring to the world that a purchaser will get this amount in perpetuity. This is a false market representation and a number that every solicitor should sue on. Not only valuation issues, but also sales issues. Whenever you see two of this number, either EBITs or cap rates, you know that you are dealing with a live one. They are trying to hedge their bets. If they have two cap rates, they believe in two multiples. Just seeing this, you will know they are unsure. Business valuations should contain detail and value of all assets owned and operated by a business. This method does not. These reports have fooled many, even the elite. Their reports are not business valuations. They are accounting reports based on accounting concepts. They deny the existence of truth, i.e. the existence of tangible assets. They exist, so why don't they appear in their reports? And even if they acknowledge such, they believe the numbers in the balance sheet are correct, i.e. written down values. What utter bunkum. Imagine they go before a judge and he asks them, where are the tangible assets in your report? Well, Your Honour, they are written down to zero in the balance sheet, so we believe they don't matter. Insurance companies would love that answer, and banks who have just lent money on the assets would hate the answer. Sometimes all that is left is the plant and equipment. And by the way, they believe in negative goodwill, which is insane. If you have a car worth 50k and the business runs at a loss, you can close the door and still sell your tangible assets at market value. Never, ever use accounting methods trying to value a business. Those who have in the past cannot escape their reports. Most of their reports will be on record for all to see. They are deficient in content, yet have fooled banking executives, government departments and employees, judges, barristers and solicitors for a long time, but not anymore. Sales is the only provable number and the only figure that is proof of market interaction, and the only figure that can prove source, and the only figure that creates value. All the others are expenses. Financial statements reflect the price paid by current owners, which may or may not be at market value. There is a new methodology that is faster, safer and more reliable, and it is all contained in my book and can be understood by watching my videos. The new methodology is clear, it's open, transparent, easy to follow, uses only provable numbers and is based on true market activity, and comparison of all asset classes are inspected, researched and tabulated in a graphic format for you to comprehend. It can even value all other intangibles, and it can tell you what the values will be before you get there. Nothing is hidden. There are no secret formulas, innuendos, guesswork, manipulation or manufactured numbers. And we never alter financial statements to produce unachievable numbers such as future maintainable earnings. What utter hogwash! And we can value at any time and anywhere and for any reason, and we do not have to wait for the preparation of financial statements or invent titles for methodologies such as top-down or bottom-up, or, as we just said, future maintainable earnings. You are less likely to be challenged If you have inspected, researched and valued every asset and component, both tangible and intangible, and separately based your findings on current market activity, in other words, comply with Spencer's case. To be an expert, you must be able to answer every question that is thrown at you and give evidence to support your answer. It is my aim to assist the legal fraternity in the identification of suspect and deficient reports and preserve the rights, equities and privileges of the business community. That concludes today's presentation. I hope you get your copy of my book soon. Thanks for watching.